Welcome to Step 5, Investing. And now, finally, let's talk about your resident money superpower. By the way, I just love stock photography because you got to wonder, what were they thinking when they made this picture? Some lady rolling around in money. But the reason I'm using it is because when you're in attending, obviously, you're going to spend all your free time rolling around in your extra money because it's just how we do. It's how we roll. Your resident money superpower, when it comes to building wealth, all right, what is the most valuable thing in the world? Is it money? No, it's time. And that's the one thing you have going for you in residency, and the one thing your attendings don't have, your youth. The earlier you start investing, the more your money will grow. That means you can invest less money and it will grow more because it has longer to grow. Here's an example. Let's compare your money's growth to your attendings. Let's say you both want to save $2 million for retirement at age 65. And we will assume that the investment value increases 7% annually on average. That's because the average growth of the US stock market after inflation is 7%. So this is you starting at age 27. You would have 38 years to invest. So that means you would need to save $936 a month. I know that's a high number to expect during residency, and I wouldn't expect you to save that much. This is just for the purposes of this example. Your attendings, starting at age 37, they'd have to save $2,000 every month to retire with $2 million. And if they started at age 47, they would have to save $4,750 a month to reach that $2 million level. The exponential part of the curve takes time to develop, and it really kicks in around year 25. The reason time has such a big impact on the growth of your investments is due to compounding. That is when your investment gains are reinvested to create additional earnings. It's the exact same idea as capitalization, except in this case, compounding works for you instead of against you. And it takes time for this to kick in. So you can see where it kicks in, and that is where the exponential curve gets steeper. So let me explain this. So here we are investing for 10 years. Now, the green, the blue, the light blue is the principal. So that's how much money you are contributing every month to your account. The green is the account balance, which is the combination of how much you contribute and the interest that it gains. And then the dark blue, this navy line here, is the interest growth. Okay, so you can see that this one has a bit of a curve to it. And at 10 years, it starts to curve up. If we go to investing for 15 years, well, now between 10 and 15, that slope is getting a little bit steeper. If we go down here 20 years, the slope compared, between 15 and 20 years is much steeper than the slope between 10 and 15 years. And now, if we look at investing for 25 years, we can see here that the slope is really starting to become much more steep, and between year 20 and 25, it's really starting to take off. The other thing that's interesting here is that if you look at the breakdown of your contributions versus your interest, at this point, the contributions are less than the actual growth. So you have more, the balance of this account is growing more from the interest than from the actual amount of money you put into it. Versus when you first started out, your contributions were 70% of your balance and your interest was only 30%. Over time, because you're reinvesting the gains, your contributions are much smaller than the interest growth. And so, to make the most of your resident money superpower, which is your youth, start investing now. It does not have to be a lot of money. I am going to show you an example of exactly how you can start doing this now as a resident. First, though, I'm going to explain what investing is, and then I'm going to show you how to do it really easily. So what does it mean to invest your money? Investing just means you use your money to purchase something that you think is going to increase in value over time, and when it does, you sell it in the future for more than you paid for it. The thing that you buy is called an asset. For example, a stock is an asset that should increase in value over time. The profit you make when you sell the stock or the asset is called a capital gain. There are lots of things that you can invest in. The most popular assets include stocks, bonds, and real estate. A stock is a portion or a share of a company that you own. We're going to talk about that in a little more detail. Bonds. There are three kinds of bonds: treasury bonds, corporate bonds, and municipal bonds. A bond is just a loan where you are the lender. You are lending your money to the U.S. government, as in a treasury bond, or a corporation, which is a corporate bond, or a local government, which is a municipal bond. Your profit is the interest that you earn from the loan or the bond. Real estate. This is a powerful asset because real estate is a wealth building tool and it can reduce your taxes. There are three main ways to invest in real estate. You can be a property owner, where you directly rent out your property, or you can participate in a group who pool their money together to purchase a property, and that's called a real estate syndicate. Or you can buy a REIT, which is a real estate investment trust, and that is just a way that real estate is traded on the stock market. Other assets include cryptocurrency, and when I'm speaking about investment cryptocurrency, I am specifically referring to Bitcoin, venture capital, and private investments. So venture capital is when you invest money in a new business, like a startup, and then when they become profitable, you get gains. Private investments can also include peer-to-peer lending. For example, there's a website where physicians can actually lend to peer physicians, or things like that. Notice I do not include anything like fine art or collectibles on this, or gold. No, none of that. We're not doing that. Just what you see here. These are some pretty great categories to invest in. When it comes to investing, you will often hear the term portfolio. The literal definition of portfolio is either a flat case that holds drawings or maps, or a range of investments held by a person or an organization. Think of it like a collection. A portfolio is just a collection of drawings, a collection of cameras, marbles, guitars, or a collection of assets. When you hear the term diversified portfolio, it means that you have a collection of different kinds of assets, and you don't own just one kind of asset like all stocks or all bonds. The reason people want diversified portfolios is to reduce the risk of loss, the idea being that each different asset class performs differently. So if stocks are up, bonds are down, etc., boom, you protected yourself against loss from your stocks going down. If bonds go up, and you've got the bonds. This used to be true. However, nowadays, we're not seeing that it's really true anymore. When stocks are down, so are bonds, real estate, and Bitcoin. If the market is down, chances are new startup companies aren't doing so hot either. So the idea that diversifying your portfolio with different kinds of investments will save you from loss is a little bit outdated, although it can definitely happen. The real reason to diversify is that each asset class has its own benefits, and those really are different between each asset class. For example, I mentioned real estate. It's wealth building because it helps you lower taxes and it provides cash flow. You're not going to find that with stocks. With other assets like stocks, you have to sell them in order to get your cash. Bitcoin is a separate entity altogether. This one has the benefit of being a standard bearer asset, meaning it's yours and no one can ever take it away from you because it's not held anywhere like in a bank or anything. There's no third party between you and your Bitcoin. Plus, Bitcoin is resistant to inflation because there's a limited amount of Bitcoin. There's only 21 million Bitcoin, and they're not going to make any more of it. So there are good reasons to diversify still. So now you understand what an asset is and that you'd like to have different kinds of assets in your collection, aka portfolio. Well, where do you keep your assets? Stocks and bonds are held in investment bank accounts. Bitcoin is held on a hardware wallet, it's like a fancy thumb drive. Please do not keep it on the exchange you purchased it on. That is a place where it could be stolen. Real estate is actual tangible property. Your venture capital is held by the company you invested in, and when they make profits, they give you your profits back in cash. So let's focus on investment bank accounts because these are the ones you'll be using for stocks and bonds. Think of an investment account like a bucket. It's just a container that holds your investments, which are stocks and bonds. An investment bank is like the tool shed that holds the buckets. All right, so the account is the bucket. It holds the investments, stocks and bonds, and the bank is the tool shed that holds the bucket, aka account. There are different types of buckets, and they can all hold the same stocks and bonds. And any of these buckets can be stored in any tool shed. So any investment bank can offer you any of these types of accounts, and you can hold any stocks and bonds that you want in these accounts with certain restrictions based on who is managing the account. There are lots of investment banks in the US, but the biggest ones are TD Ameritrade, Chuck Schwab, and Fidelity. Chuck bought TDA back in, I think, 2019, but they still haven't formally combined yet. So let's go back to the buckets. Each bucket represents a type of account. We have 401ks, Roth IRAs, traditional IRAs, 529 college savings accounts, and health savings accounts. And we have brokerage accounts. The differences between these accounts is that some of them have tax benefits and some of them don't. Everything here except for the brokerage account has tax advantages. And these tax advantage accounts were created by Congress, and they are creatively named after the tax code that describes them, like 401k or 529, or the congressperson who created them, like Senator William Roth. By the way, IRA stands for Individual Retirement Arrangement, not Individual Retirement Account, which you will never need to know unless you participate. You will never need to know that unless you participate in some kind of nerd Trivial Pursuit game. But if you do, Individual Retirement Arrangement. A 401k is an account that is created by an employer as an employee benefit. All the money that goes in here is taken out of your paycheck before taxes, and that reduces the total amount of money that you're taxed on for that year. You pay the tax on the money when you withdraw it in retirement. Money that is invested before being taxed is called a pre-tax contribution. Since you pay tax later, this is also called tax deferred. So some employers offer a match, and that means that they will match your contributions up to a certain percentage of your salary, anywhere from about 3 to 6%. Now, oftentimes you'll hear this called free money. People say, oh, it's free money, so you better take it. I agree that you should definitely take it, but I would not call it free money. This is money that you work for and you earn. It's just that not everyone knows to sign up for this benefit. The maximal annual contribution to this account is $20,500 in the year 2022. A traditional IRA works the same way. You invest pre-tax money and it reduces your income tax, and then you pay the income tax when you withdraw it in retirement. The maximum you can put in here every year is $6,000. A Roth IRA is a little different. You invest post-tax money, which is the money you've already paid income tax on. So this does not reduce your income tax that year, but the beauty of the Roth is that your investment gains are never taxed. And since you've already paid tax on the money that you put in, your withdrawals are never taxed. This is major. The max contribution each year is $6,000, and you can't have both a traditional and a Roth in the same year. A 529 college savings account works in a similar way. You put in post-tax money, and as long as the gains are used for education, they're never taxed. The best part is it doesn't factor in as heavily with the FAFSA, so you can still be eligible for a good amount of financial aid. A health savings account is the best of both worlds. You put in pre-tax money, but the gains are never taxed, just like a Roth. The conditions are you have to use the money for medical expenses or in retirement. There are a lot more details to this particular one, but I'm just giving you the general overview here. All of the accounts with tax advantages come with rules. There are rules about how much money you can invest, when you can take out your money, how you can use the money, and there are money penalties for breaking those rules. These rules are made by Congress and they are written into the tax code. There is one investment account that does not have tax benefits, and this is called a brokerage account. And it's just a regular old bank account that you open up at an investment bank. You are in complete control of the money. You can invest it however you like, and you can use it however you like, whenever you like. Any gains are taxed as capital gains, which is a slightly lower rate than the income tax rate. In general, as an attending, your strategy will be to max out your tax-advantaged accounts each year first. So the 401k, IRA, and then invest the excess into a brokerage account and or real estate or other things. Okay, now I'd like to explain stocks and the stock market, and then we will talk about the easiest way for you to get started investing right now. So what is a stock? If a company is a pie, then a stock is a slice of that pie. Companies sell their slices of pie to raise money so they can grow. People buy the slices of pie, also known as stocks or shares, because they perceive the company as valuable, and therefore they expect the value of the company and its stock to go up over time. For example, Apple. Apple is the most highly valued company in the entire world at $2.5 trillion. And the way they get to that by figure is by multiplying the share of Apple price by the number of shares available. At the time I started making this presentation, Apple was dipped down to 153, but the day I'm making this presentation, it's up to 171. So that's why you see a little difference here and here. But this chart here is important because all stocks have a chart that tracks their performance. Performance is a measure of the stock price over time, and this is Apple's chart over the past 4.5–5 years. Even with the recent dip here, you can see it has performed very well on average over the past 5 years. So how do you buy or sell a stock? You go to the stock market. And there's not just one stock market, there are stock markets all over the world. Each one of these octagons is a stock market. The biggest ones you can see here are the New York Stock Exchange and the NASDAQ in the United States. There's also stock exchanges, smaller ones throughout each country that you don't see on that map. But that said, in general, in the United States, when we refer to the stock market, we are referring to the New York Stock Exchange and the NASDAQ. These are the two largest stock markets in the US and in the world. So what is a stock market? It is literally a place where stocks are bought and sold. Another way of saying it is they are exchanged or traded. The exchanges used to have stock traders rushing about, having heart attacks, right, like this, but now stock exchanges are really just rooms of computers in New Jersey. This New York Stock Exchange stock floor is just for show. It's a backdrop for the evening news. Nowadays, to buy and sell stocks, you can just hop on your computer, log into your brokerage account, and place an order. In the olden days, you had to use a telephone to call a stockbroker. You had to use this schmuck to call a stockbroker, the schmuck, who would place the order, shoot it down a tube, then out onto the stock floor where the heart attack people would run around and get it filled. They were like physically running orders around on pieces of paper, getting it filled for you. Now, all of this happens in millionths of a second via fiber optic cables that connect your brokerage to an exchange somewhere in the bowels of New Jersey. So how do you decide what to buy? Well, you could research a company, look at its balance sheet, learn fundamentals, and decide if you think it's going to increase in value over time, then you could buy it. Blech. Or you could just keep it simple and invest in the whole United States stock market. That's every single stock bought and sold in the US with one purchase. You want the highest reward with the least amount of effort possible. Hence, I introduced to you the index fund. An index fund is a basket full of stocks, and they are selected to mimic the performance of a stock index. An index is a ruler or a benchmark. For example, the most famous stock index is the S&P 500. This index is a collection of the 500 largest companies in the United States. In fact, these are the top 10 largest companies in the United States, and they are the top 10 in the S&P 500 index. All right, so it's a benchmark. The index is a collection of those 500 largest companies in the United States, and the way that this index performs is used as a benchmark for other investments. We compare other investments to the S&P 500 to see if they're doing better or worse. For example, here is a comparison of an S&P 500 index fund, also called SPY, to the S&P 500 index. So the index fund, the SPY, is in purple, and that's that purple line here, and then the red and green is the index itself, and you can see that the purple exactly tracks the S&P 500 index itself. Now here's an example of Apple compared to the S&P 500 index. So Apple is this turquoise line. Now Apple has done so well that you can see the S&P 500 is flat, a little bit flatter here in this graph, because in order to fit both graphs on the same page, you had to flatten this line out a little bit. Look how well Apple has performed, even with recent drops, compared to the S&P 500. And it is outperformed the S&P 500. This is also called beating the market. That's what people mean when they say beating the market. Here's another example. This is the company Beyond Meat. It makes plant-based meat products, so like faux meat, versus the S&P 500. So this turquoise, well, I'd say this is not turquoise. This is like a light sky blue, Carolina blue, if you will. This color is the Beyond Meat chart, and the S&P 500 is the green and red down here. Okay, so you can see when Beyond Meat went public, took off like a rocket. It really outperformed. Ooh, then it dropped down, and then down, really back down, up, down, up, down, up, down, up, down. It came back a little bit here, and then it has just continued to completely go into the toilet. Boom. The S&P 500, on average, over the past 90 years, has returned about 7% annually when adjusted for inflation. So it returns about 10% on average, and when you adjust it for inflation, it's about 7%. That's a good number to use when you're trying to estimate investments. Some years it returns 30%. Some years it returns like negative 2%. But on average, as you can see over time, the value is always going up. And that is why it's a great long-term investment, even when the stock market crashed. So here's your 1929 crash. This is the worst crash ever. It took a while, but it came back. Came back, did great. Oh, here's 1987, October 19th, 1987, Black Monday. Ooh, stock market dropped 30% in one day. That was harsh. But it came back, and it continued to go up. And it peaked up here. That was the dot-com bubble. Everybody buying stuff like pets.com, companies that turned out to be totally worthless. And when everyone figured that out, boom, dot-com bubble, drop. But it recovered until, boom, the 2008 great financial crisis, when everybody discovered that all of those mortgage-backed securities were, in fact, actually worthless. This was a mega crisis. This was a worldwide financial crisis. Horrible. But it recovered. And look at it now, still going back up. This is the pandemic, March 2020. I mean, that was really rough, but it came back up. So over time, it does recover. And when the value is down, we call that a sale. So the fund is the basket, the index is its contents. What is the simplest way to invest? All right, here's what you're going to do. The easiest way to invest. Step 1, go pick out a investment bank. Step 2. So step 1, go to your bank, open a Roth IRA account. Step 2, put money in the Roth IRA account. So you're going to set up a transfer from your checking account to your investment bank Roth IRA account, and you're going to automate it. So it's an automatic deduction every month. You never even see that money, and there's no temptation to spend it. It just goes right into your Roth IRA account. Once it's in there, step 3, you've got to use it to buy something, buy an asset. And so you're going to use it to buy like a nice index fund. And that's it. I want to just mention that sometimes people can get a little confused here between step 2 and 3. and they think that they've put money into their Roth IRA account, and then so therefore it's invested. But in actuality, you have to do step 3. You have to actually take the money in your account and purchase an index fund with it in order for that money to actually be invested. Because remember, an investment is just that you've used your money to purchase an asset. Until you've used your money to purchase an asset, it is not invested. So it would just be sitting in your bank account making 0% interest, or maybe 0.000002% interest or something like that, but it wouldn't be growing at all. So just be careful. Make sure that you do invest it once you put the money into the account. Here are some examples of solid index funds that you could try. I'm using Vanguard as an example. There are lots of companies that make index funds. Spider down here on the bottom left corner is one of them. Invesco is another. There are many companies, Fidelity, that make their own index fund products. But Vanguard, you'll typically see, is referred to a lot because Vanguard was the vanguard in developing index funds. They pretty much authored this product back in the 70s, and they're really good at it. And they make good funds that track indexes well, and they are low cost. So the fees are really low. What you see here, VTI, VOO, SPY, and QQQ, those are called ticker symbols. Those are the abbreviated symbols for each type of fund. So when you're going to purchase or sell a fund, you're not going to see it listed as Vanguard Total U.S. Stock Market Fund. You're going to see it listed as VTI. Okay, so you just want to know the ticker symbol for each fund that you're interested in. So VTI is the Vanguard Total U.S. Stock Market Fund. When you purchase this fund, you are purchasing basically the whole U.S. stock market. VOO is the Vanguard S&P 500 Index Fund, so it tracks the 500 largest companies in the United States. SPY is the Spider S&P 500 Index Fund, also tracks the S&P 500 Index. The Qs, or the QQQ, is the Invesco QQQ Trust. It tracks the NASDAQ 100 Index, which is essentially a tech fund. So go ahead and get cracking on that Roth IRA, and here's what that's going to look like. Let's do a little example so that I can really illustrate how this would work for you. So overall, monthly expenses here, big picture, your housing is going to be about 1/3 of your gross pay. Your student loan, if you've seen in the other video, you're going to be on the repay plan, and that's allowing you to maximize your government subsidized interest and any PSLF, and to prevent capitalization on your loan so that you can keep that principal down. So you're on your student loan repayment plan, and then you're going to have savings. So the first, so you're going to automate this straight up automated deduction from your checking account. At the residency level, I think 10% of your gross or net income is totally acceptable. At the attending level, you want to aim for about 20% or more of your gross income level. So you're going to take that, and for this example, I'm going to use net. 10% of your net income, just to keep it even simpler, show you that it's totally doable. So you're first going to take that money and you're going to invest it into the emergency fund, which get about 3% of your income that you need to live off of, 3% of your monthly expenses, not your salary. Once you've got that, you're going to then take that automated savings amount and you're going to put it towards any credit card debt you have, and you're going to aggressively pay that off. The reason I say to do the emergency fund before the credit card debt is because the emergency fund is designed to keep you out of further debt. So you want that built up before you tackle the extra credit card debt, because you don't want to be in a situation where you have an emergency and it puts you into further debt. Okay? So while you're building your emergency fund, you're just going to pay your minimums on your credit cards. Once that's built, then you can start putting all of your savings towards your credit card debt. And once that is paid off, you're going to start investing your money into your Roth IRA. So let's do an example here. This is, I'm using some income figures from my former program for 2022. And so for a PGY1, the current gross annual income is $63,775. The net annual is $47,400. Like we showed in the student loan video, the student loan interest is about average 5.8%, and the repay payment is about $360 a month. And if you save 10% of your net income, that's $395. And if you do all of these, then that leaves you with $1,444 for the rest of your monthly expenses, not including your rent. So I didn't list your rent or your mortgage here, but you wanted about $1,700 or less. Year 2, the gross income is $66,000, the net is about $49,000, average interest is 6.0, and your student loan repayment is $380 monthly. If you save 10% of your net, that is $408 a month, and after your income, your rent or your mortgage, you have $1,500 to spend every month, and this is $74 a month more than you had when you were PGY1. Now, just one caveat, I'm using the current incomes for the current rates. So these would be a little bit different if you just started here as a 1 and you went every year. Every year your salary increases by 3.5%. And I'm also using the student loan interest for each individual year. I probably should have done it where I used one person starting here and just stuck with the 5.8%. But that's how I did it. So in case that's confusing. But again, this is just a general overview to give you an idea of how you can do this. In year 3, making about 68 gross, taking home about 50, repay payment, student loans $399 a month, 10% savings a month, $420, for $1,500 left over at the end of the month, almost $1,600 left over. And in year 4, your gross 71, almost 72. Your net annual is almost $52,500. Student loan 5.8%. Monthly payment $427, and your 10% net is $438 for a total of $1,700 left over at the end of the month, which is $115 more per month than you had the year before. As a 5, you have a gross annual income of $75,000. You net $54,500. Student loan interest is a little bit variable depending on when you started. Your monthly payment for student loans $454. 10% net savings is $455 a month, and you have $1,800 left over to play with at the end of the month, which is $106 more than you had the year before. So if you invest your money, here's what's going to look like. You open a Roth IRA account at a brokerage firm. You invest it in VTI, in this example, at 7% an average interest rate return. As a PGY1, on average, about age 26, you're going to be putting in $395 per month. This is all based on these numbers here. Okay. So you're going to put in $395 a month. You start at 0. Over the course of 6 months, you put in $2,370, and you make $34 in interest. You finish the year with a total balance of $2,404. The reason it's 6 months is because I give you 6 months to save for an emergency fund. And that could be during your grace period before your student loans are due. So you could really put that, grace period, you could put that student loan payment plus your savings payment both towards your emergency savings for that month. Okay. In your second year, you are now contributing $408 a month towards your IRA. You start the year off at a balance of $2,400. You contribute $4,800 that year. Your gains are $323 of interest, and you finish the year with an account balance of $7,623. In your third year, you're now contributing $420 a month. You start with $7,623 in your account at the beginning of the year. You contribute $5,000 that year, and your gains are $693. You finished the year with an account balance of $13,357. PGY 4, you're now contributing $438 a month. You start out that year at $13,357. You contribute $5,256 that year, and your gains are $1,102 in interest. You finish the year with a balance of $19,714. PGY 5, you're now saving $455 a month. Started that year at $19,700. You contribute $5,460 that year. You gain $1,500 in interest, and you finish with a balance of $26,727. So you now have $26,727 nest egg when you finish training. You saved $23,000 and you made $3,700 off of that $23,000 in passive income. Your money earned $3,000 for you just because it was invested. And all of this happened while you were paying your student loans and getting that nice government subsidy of the interest payments with repay. So you avoided capitalization as well. If you never touched this account again, you never contributed another dime, in 35 years when you retire, it would have earned $258,626 in interest. And it would be worth $285,000. Like, whoa! Look at this. Your contributions were 9% of the total balance, and your 91% is due to interest that you earned. So if you never touched it again, look at that. And that's your resident superpower, because you did it when you were young. And that's the end of our Resident Superpower Masterclass. If you found this video helpful, please hit like and subscribe to the Money Med School YouTube channel.